Good afternoon. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I am Rose Marcello. I'm a client portfolio manager at IEGAM, and my guest today is Marc Gagnon, portfolio manager, North American Equities. Mark is an award winning portfolio manager with a long track record in Canadian equity, real estate income, and small cap strategies. Good afternoon, Mark.
Hello, Rose. Good afternoon.
Thank you for being here. It's always a pleasure.
Yeah,
And
it's a pleasure
today,
for me too.
and today with Mark, we'll have an update on the Canadian stock market, changes that he has made to his Canadian equity portfolios, but as well as risks and opportunities that is monitoring for the rest of the year. Mark, I'd like to start with the stock market rally that started in 2023, but where we had a very good rebound, but this has continued for the first quarter. How would you rank Canadian stocks relative to global markets during that period? And is there any specific factors or sectors that are driving this performance?
Yes, obviously, I think the first thing we can mention about that is the fact that the US market is the best performing one so far this year in 2024. So we are at the end of March, March 25th, and the return of the S&P 500 is at 13.5%, which is excellent, of course, after only 3 months. So what's going on there? Let's clarify that right away. It's more of the same, if I can say, of what happened in 2023. Everything related to AI in the United States is performing extremely well. All the messages that we hear from the different players, the customers, everyone that supplies the chips, for example, all the messages are quite positive. On the industry right now. The demand is there. The demand for supplying and building all the infrastructure to allow for all the computing behind those large model continue to be there. And NVIDIA just did their annual big meeting where all the
The General
developers,
Assembly.
yeah, the General Assembly, and where all the developers were invited and so on. And they sounded very optimistic. They released a chip that is quite interesting, the Blackwell one, where now it's not only a chip that is more performing, but it's a whole ecosystem that goes with it, where it's going to help AI developer to develop even faster. So, in a nutshell, everything related to AI in the United States continue to rip off. That's going extremely well, and that's one of the main reasons why the U.S. performance is so strong. We can also add that the U.S. economy is still doing, relatively well. Growth is still there, so everybody is kind of inclined to think that we will succeed. That soft landing that the Fed is trying to orchestrate, and that's quite a good news. But in the same time, that put a little more pressure on what will happen to interest rate. Will the Fed will cut anytime soon? And that's interesting because the market thought at the beginning of the year that it would cut. The first cut would be in March, and there we are, almost at the end of the month, and everybody now knows that it will be at the earlier in June and maybe even in July. But nevertheless, what we thought that would be maybe a negative market news for the market didn't seems to bother the equity market that much, which is another story for the bond market because the bond market didn't perform that well at all. We might come back to that because it was mostly the message that I said or that I mentioned when we did that the first podcast of this year. But before going any further in that direction, I would like to come back and just try to answer your question. So now let's turn to the Canadian stock market, which is a little less performing at 5.6% after almost 3 months in 2024. So what's interesting there, it's not a bad return, of course. And what's interesting is since the beginning of March, we have seen commodities doing much better. Energy with WTI above 80 now, around 81, 82. We have gold also as its peak right now. And we have also copper above $4 per pound. That's a psychological level that is quite interesting for the commodity. And of course, the Canadian market benefit from that. And that's what one of our theses with a synchronized recovery around the world, that commodities will do well and that would support the Canadian market. And maybe the last region of the world we can talk about is simply the rest of the world except US and Canada, which we will measure with the index called EFI, and that index is up 8.9%. So that's quite a good return. So overall, stocks, Canadian, but also foreign stocks did fairly well in the first quarter, much better than bonds.
Good to know. So even though Canada is not as exposed to tech than the US, it did benefit with a few company. I don't know if you want to mention Celestica, but looking at this and going a little bit back to your comments on commodities, what's your take on current valuation of Canadian equities? And are there any sectors that right now are good opportunities?
Yeah, that's I think that's one thing that favor Canada. When we talk about valuation, we use one of the matrix that is often used is the price earning. And what you're trying to establish is how expensive is the overall market compared to the earning that it can produce. And the Canadian stock market is around a little less than 15 times, and the US market is around 20. So the Canadian market is much cheaper than the US market, and that spread is on an historical basis higher than usual. But at the same time, I have to be completely honest, and to do the full analysis, you have also to take in account the fact that how fast your earnings will grow. And it's possible that in the US it grows faster than in Canada because we were talking about AI and all the technology in the US that is doing extremely well for those reasons and other reasons. But therefore, you can expect maybe that earnings will grow faster in the US than in Canada. But when or if, no, I'm not going to say if, I'm really going to say when we will have a synchronized recovery, and that might be the second part of this year. That might be as soon as the last 6 months of 2024, with Europe doing better, with the China doing also with the goal that they have established recently of a growth of 5%. They will probably commit some money through stimulus. So China should do okay. Europe should do better. The U.S. with a soft landing should do well too. So we would have that synchronized recovery that will help commodities, and that's going to be quite interesting for Canada, especially if at one point in the U.S. The growth of AI, for example, might or if it's a slow patch, that could be quite interesting to be invested in Canada in that situation. Also, another sector that we like is the financial, especially the banks, because we think that in Canada the economic situation is not as good that in the US. It's not that bad though, but we think that because of the differences between the mortgage market in the US and in Canada, where in Canada the average length of a mortgage is much smaller, closer to 5 years. In the US, you can have a mortgage of 30 years, for example. In Canada, the higher interest rates bite a lot more and a lot faster than the US on the economy. So we think that the Bank of Canada will lower rates even maybe we think could be even stronger than in the US in 2024. We think it would deserve to be more aggressive on cutting rates. I don't know if the Bank of Canada will do it, but at least it will cut as much as in the US. And that will help banks because it will probably translate with lower bankruptcy for consumers that hold mortgages. and that will favor, of course, profitability, banks' profitability. So that's another sector that we think going to do well in 2024, maybe in the latest part, though. The last part of the Canadian market is a bit of the mix of the rest, which is mostly industrial, consumer staple, technology, discretionary, and so on. And we like industrial and we like a lot also consumer discretionary because it's probably in that sector that we're going to find the cheapest stocks right now because they are not really discounting that recovery. And we think that profit growth will turn out to be better than expected. So that's a sector that we have a lot of enthusiasm about, and we think we're going to be able to extract a couple of basis points in terms of value added from there until the end of the year.
Good, Mark. So considering all this, what are any big changes in the holdings of your portfolios, of your Canadian equity portfolios in Q1, in terms of sectors or individual stocks? Where are you putting your bets right now?
Yeah, right at if you listen to my previous podcasts, you probably or you may remember that I was optimist for 2024 for stocks, both Canadian and US. But I thought that the first quarter will be a little the slower one, the maybe the less performing one of the 4 quarters of this year. Uh, and that's maybe I was maybe not fully right. But two sectors did not perform well, and they were the defensive ones. I'm thinking about utilities and also communications. And that's interesting because interest rates stayed and even went a little higher the 10 years in Canada. So those sectors usually perform well when interest rates go down, especially the long end of the curve, which we call the 10 years in terms of maturity. So that sector, we started to let go mainly the utilities, which was a good thing. We were more positive on the communication, but one thing that turned out to happen is the after the acquisition of Shaw by Rogers and also a portion by Quebecor, we are kind of witnessing a price war in Canada, which is quite a good thing, by the way, for consumers, but less for companies. And we've seen that the results of that price war, by the way, in the last CPI numbers. So the sector is not really doing well. We're having BCE, for example, at an ultimate low of several years. TELUS also going lower. And although Rogers didn't perform that bad, it didn't really outperform either. So that's a sector we sold in the first quarter of this year. Um, right at the beginning, we found so much value in energy. We thought it would take much longer for that bet to pay. So we're quite happy with the barrel above 80, close to 81, 82, like I said, and that's a bet that performed fairly well. We invested in some names, some smaller names that are tend to overperform when the commodity is doing well. And we were also, especially compared to our peers, we were overweight also commodities, copper, for example. And that part also paid interestingly for the unit holder. So overall, after 1 quarter on a gross basis, we're close to 1% ahead of the index. We're quite pleased, and we're first quartile according to our rankings. So that's quite a positive news. So we're quite happy about that.
That's great to hear, and also great to hear that you were actually positioned for that recovery in economic activity, like we had discussed earlier in the year. Any last thoughts, maybe, about
Yeah,
markets or portfolios?
no, I think it's gonna be an interesting year, a positive year for equity returns. Um, there's two things that I'm watching if I want to be cautious. Uh, the first one is what will happen to inflation? Will it continue to go down? If it doesn't, and the economic, and I'm more talking about the US than Canada here, I think that the economic performance, the economy will continue to grow, which will probably um, help to trigger and generate still earning growth. So I think that the market that will be the most at risk will be the bond market in that scenario. And let's say that inflation continue to go down and the Fed cuts interest rate as expected. I think that the stock market will do well also. So it's almost a win-win situation for the stock market, the US, and uh, basically Canada, except if we account for some specific subtleties, I think it's going to be the same. Um, the other risk that that is a little farther away will be the U.S. election. I see a couple of risks there. The first one will be some disturbance and possible disturbance in the let's say in the society. If things are too, let's say we have a very tight election, there could be a lot of arguments and a lot of uncertainty for a while at least on how it will get resolved. And the other thing, if Trump gets elected, a lot of things in this program will favor some inflation coming back, which I don't think that will be perceived that well by the market. But I would say at this point, that's probably the topic of another podcast somewhere in the future.
Definitely, definitely. Yeah, as we get closer to November, we're probably going to have more chatter and more discussion about elections and the impact on markets. Well, thank you so much for your time, Mark. It's always informative.
Oh, it was a pleasure.
Thanks. Have a good afternoon.
Bye.